Good afternoon and welcome to the 2021 Johnson Investment Council Virtual Wealth Management Forum. My name is Jason Jackman, President and Chief Investment Officer of Johnson Investment Council, and I want to thank you for joining us today. For those that were able to join a few minutes early, I hope you enjoyed the performance by musical group Cardinal Quartet, a local performing music group here in Cincinnati. We're proud to provide support to local artists during this especially trying time for the arts community with so many limitations on live performances. Before we get to the heart of the presentation, I just wanted to share a few brief comments on the firm. Last year was challenging in so many ways, but I'm really proud of the way the Johnson team rallied together and supported one another and served clients during a time of economic and market volatility and really served clients in novel and unique ways. You may have noticed some slides scrolling through during the musical performance with highlights of the past year. You saw some regional and national recognition, things like our investment management approach, our service offering, and even our culture. But many of you paid us the ultimate compliment last year of referring your family, friends, and colleagues to us, and we continue to grow. Our assets under management now exceed $15 billion across all our offices. But I want to stress to you today, growth is not our objective. Delivering on our mission is. But growth has been and will continue to be an inevitable outcome of delivering on that mission. Growth means we're serving and helping more families and institutions than at any other time in our history. It means we're able to invest in our service offering and add depth and expertise to truly deliver comprehensive wealth management. And it means we have more dedicated employees and credentialed professionals than at any other time in our 55-year history. All those employees dedicated to delivering on that mission of providing financial peace of mind to clients, financial peace of mind throughout life's journey. You'll hear from several of these talented employees today, key decision makers in our investment management and wealth planning areas. You'll hear from Charles Reinhardt and Brandon Zurich, directors in our asset management division with key roles in investment strategy, talking about the markets and the economy. After a brief video on the heritage of our firm, you'll hear from Johnson Trust Company President Michael Barnes, who'll tee up a section we're calling Ask the Experts, moderated by Jarrett Levitsky, and experts Mary Burns and Tony Cure will talk about some planning strategies and tax techniques during this change of administration in Washington. I hope you'll find the next hour full of education, perspective, and insight into how we're navigating the current market environment. Many of you submitted questions during the registration process, and we'll be addressing many of those throughout the presentation today. For those of you that have questions now, please feel free to populate the chat box on your screen. We won't be addressing those live during the presentation, but we will get to you in the coming days and answer your questions directly. And finally, in keeping with COVID protocols, all our speakers will be socially distanced today for safety. So let's begin the presentation. I'll turn it over to Charles and Brandon. Thank you.
Thanks, Jason. I'm Charles Reinhardt, a director in our Johnson Asset Management Division and portfolio manager of the Johnson Equity Income Fund.
And I'm Brandon Zurich. I'm a director and fixed income portfolio manager.
Brandon, thanks for the time today. It's always fun to sit down and talk about the markets and the economy. It's been a little while since we've done this. I think the last time we were out doing an outlook was October. We didn't have the vaccine approved and there was an election on the horizon. Maybe you could update us on where we are on the economy and how those things have changed the landscape.
Yeah, sure. To make what could be a long story pretty short, I think now that we do have a reliable vaccine, that certainly puts us on a firmer path toward a more sustainable economic recovery. And if we think back and reflect on this entire economic journey that we've been on through COVID-19, I think one of the things that becomes clear is we've really been through three separate and distinct phases. The first phase I would call the lockdown phase, and I think we're all too familiar with how that ended, right? We closed large portions of our economy, and as a result, it was economically devastating. We saw one of the worst quarters for GDP growth in history. But as quickly as we locked things down, we emerged into the second phase that is categorized by large-scale government stimulus, as well as gradual economic reopening. And so those two things combined to produce one of the most impressive rebounds we've ever seen in history. But the important thing to understand is even after accounting for the large bounce that we saw during the third quarter, we were still operating at levels well below kind of pre-COVID in terms of economic activity. Very similar story when it comes to the labor market. The unemployment rate, it had come down quite significantly, but still 6, 7, 8, 9% unemployment is not only typical of a recession, but a historically severe recession. So the good news is we're now emerging into the third and final phase of this recovery, which I would call the vaccine phase. And broadening vaccine distribution will certainly help those areas of the economy that are still reeling from the effects of COVID-19. Think of restaurants and leisure and those sorts of things, help to really fully recover. So that's all pretty good news in terms of 2021 economic growth, because we've got the tail end of some stimulus continuing to work through the economy. We're likely to get another round of stimulus sometime soon, and broadening vaccine distributions will certainly be helpful. So Wall Street forecasts right now are for growth between, say, 4 and 5%. And I think there's probably some upside in that number, depending upon the speed at which we can get vaccines to market. So that does, I think, bring one question to mind, though. This theme emerged last year that the economy and the markets, they're not always that connected, right? We had what seemed like a lousy year for the economy, but the stock market didn't really seem to care. So in light of this better economic forecast over 2021, how might the market react?
I think it's a great point. If you ever needed proof that the market and the economy were two different animals, last year was that proof. Despite everything you said with the pullback and unemployment, market had a pretty good year. The S&P was up 18% for the year, which was above average in a decade of growth, uninterrupted growth. So it was actually the fourth best year in the last 10, despite it being the only year in the last 10 where we actually had a recession. I think if you look below the surface, there's definitely some differences in what we saw there. And some of that growth, well, really all of the headline market growth in terms of return, came from the market getting more expensive. Earnings were actually down last year. Yeah. But I think, if we wanted to explain why was the market up, a big part of that story has to be just the evolution of the U.S. market in some favorable ways for this particular crisis, meaning there's more of an emphasis in tech and internet retail in the U.S. market than there ever has been before. I think you can really hone in on that dynamic if you look at just the top 5 stocks. We have an exhibit that shows earnings growth for those top 5 by market cap, the largest 5 companies in the U.S. stock market. And there you see it. It's Apple, Microsoft, Amazon, Facebook, and Alphabet, or Google. And those 5 companies grew their earnings in aggregate by $23 billion last year. Which is really an amazing feat in the economy that we had. $23 billion is kind of a hard thing to contextualize, but if you put it together, that's a Procter & Gamble, 2 Krogers, 3 Fifth Thirds, and 4 Cincinnati Financials, all combined, 1 year of growth. So amazing results. Now, if I want to make that number look small, all I have to do is put it next to the change in market cap for those companies, $2.3 trillion last year. So there's the scale. That's the change in the value of those companies. Now, we would expect to see that second bar be higher. But if we use the market multiple, it'd be more like 600 billion. So 3.5 plus times what we'd expect in terms of growth in market value. A couple things driving that. One, I mentioned that earnings growth was negative. So there weren't a lot of really good, clean stories like these in the market. Investors flocked to that. The second, these are growth companies, and a lot of their values tied up in the future. Interest rates came down last year. When interest rates come down, that future growth becomes more valuable because it's cheaper to borrow. You don't have to put off as much to get there. So some dynamics that maybe put some of that growth that we saw in market value last year at risk in the future, despite these being really fantastic, well-positioned companies. Now, another dynamic that's changed because of that big growth in the market cap is that these are now equal in value to the bottom 356 companies in the market. In terms of market concentration, if you buy an S&P 500 index fund, about a quarter of your investment is in these top 5 companies. That historically has not gone well in our competitive market system, right? People come after the big winners. But I think what's interesting is that if you look at these two sides of the scale here, there's different problems on each side. The left-hand side has this valuation problem, right? This quick expansion in value. The right-hand side has the earnings problem. This is where the 15% decline in earnings came from. Actually, we've got one more exhibit on this topic that shows the difference in earnings for these two buckets over the last 3 years. If you started in 2019, that big bucket was earning about half in terms of net income of that bottom 356 companies. What we saw last year was those two things come into parity, right? We had a 40% decline on that smaller company. And these are things that are more tied to financials and industrials and things that don't do really well when the economy shut down. Now, look forward a year, 2021, what do we expect? More smooth and steady growth from the top, but this real big rebound from this bottom 356. As things get back to normal, like you said, and we get into this phase 3 of the economy, we expect there to be a big snapback. Now, interestingly, at the start of last year, 2019, the market cap of this smaller basket was about 50% higher than the top 5, which makes some sense because it earned more income. Income comes into parity, so does our market cap. Look forward a year, we expect that earnings to really bounce back on that smaller company ledger. So this plays well into what we focus on our equity selection teams. We're always focused on high quality dividend paying companies that can weather through a cycle, and there's a lot of those in that 356. So we think that'll play into our outlook. But to kind of put a bow on everything, the market was good last year despite a rough economy. As a result of that, things are more expensive. And the market's probably going to have to grow into future earnings. We think there's more room for that growth on the smaller side. But part of that outlook is tied to what happens more with the landscape. And I'm not going to let you get off talking on policy with just what we've already gone through. So, maybe monetary and what's going on at the Fed, fiscally with Congress. What's the policy landscape this year?
Yeah, the policy landscape is going to take center stage as we go through the remainder of this year. And I think it's funny, I was reflecting back, the last time you and I sat down and did an outlook like this was October. And at that point, the policy landscape was still very much up in the air. But if I remember correctly, we were saying the race for the White House was kind of a coin toss, right? A lot of the key battleground states, the polling was well within the margin of error. But what we were more confident in was that Congress would remain divided. And so that gave us some confidence that there really wouldn't be any large-scale major policy changes over the next 4 years. Well, if I've learned anything, it's expect the unexpected when it comes to predicting politics or elections. So we now know that Democrats have control not only of the White House, but also of both chambers of Congress. So this reignites that debate about what potential policy changes could be coming down the pike. I know that everyone's attention is focused firmly on the potential for tax policy changes, but before we get into taxes, I think it's important to understand the prioritization of the administration when it comes to policy this year. So we think priority number one is going to be to get one additional round of fiscal stimulus deployed, help those parts of consumers or small businesses still ailing from COVID-19, provide a bridge to broader vaccinations. That's going to be priority number one. And we already know that President Biden has proposed a $1.9 trillion spending package. That's a huge amount of stimulus. It's likely to get watered down, especially if he plans to pass that with bipartisan support. But still, anything between $600 billion and $1 trillion is likely to be meaningfully supportive of economic growth as we go through this year. But there's consequences to that, because the better the economy is this year, I think the more policymakers' attention is going to turn away from stimulating the economy and more toward paying for all of the stimulus that we've done over the course of the past 12 or 18 months. And so notably, I think that means higher tax rates. And we do know that President Biden made some campaign promises or indications that he was going to adjust taxes, do things like raise the individual income tax rate, the top bracket, back to 39.6%, adjust corporate taxes back up to 28%, adjust the way capital gains, dividends, and even estate taxes are treated. And so that's all going to work to restrain economic growth. But the important thing to understand is we don't think that that's a near-term priority. We think that that's more of a late 2021 or even 2022 type of priority for the administration. Now, I'm sure that many of you are thinking, that's it when it comes to taxes. I do want to just note, this is an economic and market discussion, right? We do have a panel of experts coming on later on that are going to give you everything you've ever wanted to know and more when it comes to how these potential policy changes might impact you as an investor or from a financial planning aspect. But to boil it down from an economic perspective, stimulus is likely to be helpful to growth, actually, at least for the first part of 2021. Throughout the later stages of 2021 and into 2022, the likelihood of both fiscal policy starting to get a bit more restrictive, as well as the potential for the Fed to start backing away from all of the stimulus it's done. We're not talking about the Fed raising rates this year, but we may not need a $7 trillion balance sheet any longer if the economy is back on firm footing. So that's kind of what we're thinking from an economics perspective. I would, again, kind of pass it over to you and just pose the question, in anticipation of some of these policy changes, both the stimulus as well as adjustments to tax rates, what kind of things are we doing in portfolios to prepare for that?
Yeah, we always know volatility is on the horizon, but we just don't know or when or what the spark might be. And you just listed a number that could be sparks. The prospect of raising corporate taxes, just half of what the 2017 tax cuts, could be a upper single digit hit on earnings. Market is how it digests that depends a lot on the timing and the situation around that. So that's one example. We could spend the rest of our time talking about each of those, but monetary policy changes, fading stimulus, these are all things that could cause some volatility in markets. We think that there is a very important distinction in different types of volatility, though, right? If you look at 10% plus pullbacks in the market, they generally fall into two baskets. You've got non-recessionary corrections, we'll call them. Mm-hmm. We've had a number of those. If I just look at the ones since the Great Financial Crisis, they range in magnitude from about 14% to 19% down. They're short. They set up good periods of return. Since the Great Financial Crisis, all of those have had a 12-month return of 30% or more following them. Those are the types of volatility spikes that you want to lean into, right? You want to rebalance into those and make sure you buy back some stocks in that environment. You don't want to change your asset allocation for that. The ones you want to consider asset allocation tweaks for are the second bucket. Those are recessionary bear markets, pardon me. So you go back to the 1930s, we've had, I think, 12 outside of last year. The average pullback is 32%. We've had several 50% or greater. They take over a year most times to reach their bottom. Those are the times you want to adjust asset allocation. Now, the reason I think it's important to go through that is, I think with the economic outlook you just laid out, these hiccups are likely to maybe slow growth or pause it a little bit, but we don't really see a recession on the near-term horizon. It'd be pretty unlikely in the next 12 months. So from an asset allocation standpoint, we're going to be patient to add some exposure to the equity markets here, but we are early in the economic cycle. It's a time when you want to have stocks in your portfolio, and we'll take advantage of volatility as it comes to do that. Mm-hmm. I think the best tool for navigating these kinds of volatility spikes outside of recession, though, is really what kinds of stocks and bonds are you buying in the portfolio. And that's where our discipline is always added value. We're focused, those of you that know us well know this already, but we're very focused on companies that can navigate a full business cycle, those that have low earnings volatility, and those that earn consistently high returns on their invested capital. If you put those dynamics together, you generally have pools of stocks that over a full peak-to-peak cycle can add value with less volatility, and they really help us out in these kind of periods of spikes. And fortunately, a lot of those companies pay higher dividends, and we shoot for a higher income in our client portfolios for lots of reasons, not the least of which a lot of people live on that income. But there's a lot of really high-quality dividend-paying stocks in that bottom 356 and smaller parts of the market that we talked about. So in terms of a 3 to 5 year outlook for our discipline of picking stocks, I think we're really well situated versus the broader market, given how focused the market's been over the last few years on growth and non-dividend paying securities.
So safe to say there's a silver lining to the narrowness of the market we saw last year.
Yeah, it sets the stage for some healthier times ahead, I think. Now, one thing you mentioned was the Fed balance sheet. And that's something that I know I talk about a lot and get a lot of questions on. Rates are low. What the Fed has done has posed the risk of maybe some inflation on the horizon. I just mentioned wanting to own bonds to help through these volatility periods, but bonds are based on interest rates. So you're on our fixed income team. What's the case for bond exposure with interest rates where they are?
Yeah, well, I'm glad you asked this question because even as crazy as the last year has been, we've been through pandemics, elections, Bitcoin mania, Tesla mania, even recently GameStop. This is far and away the question that I am asked most often. It's just, what role do high quality bonds play in my portfolio given the interest rate environment? And I think that makes sense. We are sitting near historical lows on rates, and there's starting to be some nervousness when it comes to the inflation outlook. So we'd like to offer three kind of key counterpoints that reinforce the importance of owning high quality bonds in portfolios. So first and foremost, we have to understand the role that bonds play within a diversified asset allocation. You alluded to it, right? It's the idea that bonds are not return-seeking assets, but they're risk mitigation tools. They're a way for us to offset volatility, both from an economic or market perspective. And so in that vein, still very much an important part of diversified asset allocations. The second point would be with regard to the inflation outlook. We certainly understand the idea that all of these extraordinary policy tools give some anxiety with regard to the potential for faster inflation, right? We've got a huge Fed balance sheet, lots of debt. I think there's fear that that might have consequences on the dollar and then therefore kind of spread inflation through the economy. We would, to some degree, agree that in the very near term, inflation is likely to more or less return back to normal levels. But from a secular perspective, do not see a secular inflationary outlook. And one of the key reasons why, and we've got a simple chart here, is just demographics. And so you can see what we've done is overlaid what's called the fertility rate. It's just the number of births per 1,000 women in the U.S. and advanced that indicator 25 years. And as you can see, that has historically been a very accurate predictor of the secular outlook for inflation, and at this point is not offering any warning signs that inflation is going to start heating up. The third and final point that we'd make is even if interest rates do start to or continue to increase in the near term, negative returns in bond portfolios are very rare. In fact, what we've shown here are calendar year returns for the Barclays Aggregate Bond Index. And as you can see, there have only been 3 years in the last 30 where we've had negative returns. And in fact, in the years following those periods of negative returns then tend to be pretty good. And that's no accident because reinvesting coupons or maturities at higher interest rates tends to be a very powerful force and very quickly erase the negative or suboptimal returns that you get from a rising rate environment. So to kind of summarize, we still very much believe that bonds play an important role in portfolios, offer stability. We don't secularly see a threat of inflation at the moment. And lastly, if we do get some negative returns, if yields continue to go higher, that's probably more of an opportunity than a threat. But if for some reason we do get unforeseen inflation, I was hoping that you might talk about some of the things that we're already doing in portfolios that could benefit or could protect portfolios from an inflationary environment.
Yeah, I think that the flavor of inflation that we might see goes a long way into informing how we position portfolios for that. I think you made a good secular case why there's some limiters on what near-term inflationary pressure might be. For that reason, we want to be positioned in places that can provide some inflation protection if inflation becomes a problem, but where we don't have to necessarily time our entry and exit perfectly to capture that. And so what that would mean is things, real assets that have cash flows tied to them, things like global infrastructure, real estate. These are things that we think are, can stand alone as investments outside of the inflationary environment, but the value of these properties should increase, and some of them are contractually negotiated to increase their cash flows if inflation goes up. So we think that that's the most appropriate place to be, and we think that an allocation there can provide adequate inflation protection. And the equities in the portfolio will see their cash flows go up likely as well if there's inflation. So stocks can be a hedge over the long term. So with that, maybe I'll pause and summarize. We think that we've been through one of the more interesting economic times of our lives here over the last year.
That's for sure.
Yep. We've gone through the carnage of early last year and maybe most of the V shape of the recovery with some healing still to go. We're settling into a new economic cycle. And the market has outperformed maybe our expectations based on what we've seen in the economy, and it's gotten expensive because of that. But there's some good reasons for that growth, particularly the success of what we've seen in internet and internet retail technology stocks. Those stocks have benefited to the point where they're priced for those high expectations going forward, and we think most of the value is in the smaller cap traditional economy stocks going from here on out as we see that healing in the economy. Policy is going to be a big topic. Expect fiscal stimulus, and then somehow down the line we'll have to pay the bill for that, and that might limit growth in the out years. But for the near term, more stimulus is a positive. We think that any volatility we see around these policy topics is probably a chance to lean in and rebalance a little bit more opportunistically because we don't see another recession in the near term. And in the meantime, the thing that gives us the ability to play offense in those turbulent times is good defense, and that's where the bonds in the portfolio come in and some of the inflation hedges that we have, preferring those to be focused on cash flow generating assets. So I think that's the outlook in a nutshell. Thanks for joining me today, Brandon, and thank you all for your trust and confidence. We appreciate it, and we will look to keep you informed as new developments come to bear. Now we'll share a short video with you as we reset the stage for our panel of experts talking about estate planning and tax topics. Please enjoy.
One of the most important decisions I think I made is never to sell a commission-based product. When I sit down with somebody to talk to them about their financial situation, I don't want to be in a position where I have to sell them a product of some kind, a commission-based product, so I can eat that night. I can't sell you stocks, bonds, insurance, real estate, tax shelters, annuities, vacuum cleaners, nothing. That helps because it puts me on the same side of the table as the client. The only two things we sell here is competence and integrity. Nothing else counts. So I had my very first client in 1965. I was only 23 then. I was really pursuing a career in teaching at the college level. And now here we are, much later, and we have 145 people, and we're managing $14 billion, and we have 6 locations. There's only 35 independent registered investment advisors in the United States that manage over $5 billion, and we're at 14. We have clients in 49 states, nobody in North Dakota yet.
When you think about the success he created without a business plan, there was never an intention to grow this business. It was really just about helping people on the side. And because he did such a masterful job at it, laid the foundation, instilled the values in the people as he hired, it just grew.
I probably was in business 15 or 20 years before I even had a business card. I figured if you couldn't figure out who I was, I did a lousy job of introducing myself.
When someone has had an experience here where we've really helped them through a key decision point or a key event in their life, they can't help but share it with family and friends and colleagues. 90% of our business comes from client referrals.
So peace of mind is not a one and done. It's something that changes and molds and melds through life. And we have to know our clients exceedingly well to know what that means to them.
We're just looking to make sure that the client is well cared for, and we can do that because the shareholders are sitting at the table with those clients.
Fees that are generated are only source of compensation, and when you sit on the same side of the table and you're employee owned, that objectivity really resonates with folks.
Forming the trust company has been a differentiator for us on what we mean by comprehensive wealth management. To surround our clients with the expertise where we can help families pass wealth from one generation to the next in a way that matters for them, is aligned with their values, and is done effectively and intentionally.
At Johnson Investment Counsel, we have 4 primary divisions. We have Johnson Wealth Management and Johnson Family Office Services. Both of those help the families and individuals that we work with. We have Johnson Trust Company that serves our individual clients with any kind of estate planning needs that they might have. And then we have Johnson Asset Management, which is the seat of all our investment thought, our research. We don't play around. When we do something, we're going to do it exceedingly well. We're going to resource it, and we're going to get the right people in place.
I hear stories from people that they have told me they don't even tell their pastors. I feel like what I'm doing is walking on sacred ground with them, hearing their deepest concerns for the people they love. And my job is to walk them through that process and shepherd them through to a place where they can sleep at night.
I want to look at their estate planning. I want to look at their wills, their trusts, I want to read all those things. Let me tell you what I've found, and then you can decide some other day if you want to hire us or not. If we can't add value to you in your situation, then, we're not the place for you. We're here to educate and help people. That's our goal.
Hello, my name is Michael Barnes. I am president of Johnson Trust Company. We started Johnson Trust Company over 20 years ago to help implement our clients' estate plans. We implement those plans by serving as trustee for trust accounts, as co-trustee with individual trustees, or as agent for individual trustees where the individual keeps the trustee discretion and we provide the trust administration. We also help settle our clients' estates by serving as executor or as agent for individual executors. One of the other services that we provide is also helping our clients in understanding their estate plans and updating them over time as their family situations and tax situations change. We review their documents, help them understand what their current estate plans do, and help them think through tax strategies and wealth transfer strategies to meet their objectives. We try to focus on helping our clients pass wealth in a healthy way. We feel passing health in a healthy way involves passing family values and family traditions at the same time as passing the family wealth. The next part of our presentation today, 2 of my colleagues are going to talk about income tax and estate planning strategies that we're focusing on in 2021. Our moderator is Jarrett Levitsky. He's our managing director in our private client group and on our management team. I hope you enjoy the presentation.
Good afternoon and welcome to this closing segment of our time together called Ask the Experts. And I have joining me today 2 of our in-house experts, Mary Burns, Trust Counsel and Vice President of Estate Planning for Johnson Trust Company, and Tony Cure, Head of our Wealth Management, or Wealth Planning Committee, I should say, and Managing Director of our Northeastern Ohio market. Now, Mary and Tony have expertise in the areas of estate planning and income tax planning, and as Brandon and Charles mentioned, that's what we're going to be covering here today. And Tony, I might start off by asking you, as we think about the Biden tax proposal, what we know is that is a proposal from the campaign trail. Here we are several months later, we've got a Biden administration. What do we know at this point, and how do you think things might pan out from here?
What we do know is there was an explicit proposal as part of the campaign, and nothing's changed since then. The same proposal outlines the various increases in tax credits and raising rates is all still on the table. But what's changed, of course, is now we have a president that's been elected and we have the Congress that's been elected. And as Brandon alluded to earlier, the Congress is more divided or is divided in such a manner that it is now not a split government, it is now Democratic controlled. So what that would imply is that there might be more of an appetite to get those tax rates or tax proposals through. But we're not so sure, based on all the other priorities of the administration, that that's going to happen. And in fact, I was just reading an article this morning that discussed how the Biden administration has implicitly acknowledged that what was proposed may not necessarily be what gets finalized. So still a lot on the table to be negotiated, still a lot of priorities from the administration with respect to additional stimulus package, of course the vaccine rollout, that we think later in the year would be the time that this might get addressed, maybe in the context of a combined infrastructure bill, which has bipartisan support.
Do you have any insight maybe on timing of that? I think a lot of people want to know, is this a this year package or is this a 2022 kind of thing? Any perspective there?
Yeah, I think if we had to, we're not in the business of making predictions on timing, of course, but probably later in the year, just based on priority. Our job is to make sure that we are always keeping our eye on that and making sure that we're nimble enough to execute on strategies as fast as possible when they do become law.
Gotcha. And Mary, I might ask you a question related to estate planning, because that is your expertise, right? A lot of people, when they think about taxes, they think about their tax bracket. It's all individual kind of stuff, but you're always looking at passing wealth to the next generation, doing that in a way that saves on taxes. What can you maybe enlighten us with as far as what estate taxes look like under the Biden proposal relative to where we are today?
Sure. I think, as we keep saying, this is the proposal.
Right.
This was the proposal from the campaign trail, but under President Biden's proposal at the time, we're looking at exclusions when we're talking about estate taxes. And I think it's actually important to back up first and talk about what do we have today. Currently, in 2021, a person can pass $11.7 million of wealth without incurring any estate tax. So a married couple has over $23 million that they can pass free of estate tax. That is also scheduled to sunset at the end of 2025. So starting in 2026, even if nothing else gets done, that amount will go back down to around $6 million a person. So we'll be back to a married couple being able to pass around $12 million of wealth without estate tax liability. President Biden, again, back to his campaign trail, proposed $3.5 million is the exclusion amount. So then a married couple would have $7 million between them to pass free of federal estate tax.
Gotcha. So maybe you could provide a little bit of perspective on how many people that really affects. Brandon and Charles talked about the COVID relief bill. I mean, that's $1.9 trillion and the need sometime in the future to start raising revenue. Enlighten us on what that looks like.
Sure. It's an interesting way to phrase the question, how many people that impacts. So in terms of federal estate tax returns, in 2020 it was projected there would only be around 4,000 federal estate tax returns filed in the whole country. And then fewer than 2,000 of those would actually be taxable estates. But your question implies something. It actually affects a lot more people. One, there are a lot of people who need proper planning to ensure that they don't have a federal estate tax. So that's something, of course, we'll talk about today, what kind of planning needs to be done. But I think in general, in terms of the revenue, back to what Charles and Brandon were talking about, the revenue anticipated in 2020 for estate tax revenue generation is only around $16 billion. So it's not a lot in the big scheme of things.
Tiny little drop in the bucket,
Right.
It seems like.
Right.
Gotcha. Well, thanks for that perspective. Tony, let's come to the individual side, because all of us want to know, our tax rate's going to go up, what's going to happen to my taxes?
Sure.
Can you maybe give us some details of what that proposal looked like, how that might affect individuals and families?
Sure. So I think the big takeaway that we should talk about thematically for the proposal overall is that the Biden proposal really is targeting high earners. So folks who have high income tax or high income on their tax returns every year. So to be more specific, what the proposal outlines is that they're targeting to raise the top bracket from 37%, what it is today, to 39.6% for incomes over $400,000. Now I want to put that in perspective. Again, the top bracket's at 37%, but that starts at $628,000 today. So yes, the top bracket's going up, but then the threshold for that starting is also coming down. That being said, the only change is for that level of income. There are a couple other minor changes or other changes with respect to the high income earners. The Social Security tax, which is the 6.2% payroll tax that all wage earners pay today, ends when somebody makes $143,000. Anything above that, there's no Social Security income tax on that. What the Biden proposal intends to do is to restart that at the $400,000 level. So up to 143, you have the 6.2, stops, and then goes back up, starts again at the $400,000. There's also some details around limiting the effectiveness of taking tax deductions with retirement contributions. There's a technique that they're looking to cap those at 28%. Again, more in the details and the weeds on how this works, but it's really, again, thematically targeted at the higher income earners.
And you had said something about the 400,000. That's taxable income.
Correct.
Correct. Okay.
That's an important distinction I'm glad you brought up. It's not gross income. When you're looking at your tax return, gross is the top line, adjustments and deductions eventually get you down to the taxable income line where tax is calculated.
Gotcha. So folks who are saying, well, my taxable income is not at that level, has there been any discussion about what happens below that? Is there risk that those tax brackets change, or that it sounds like taxes aren't scheduled to be raised for that level, but what about the brackets themselves?
No changes outlined in the proposal for those types of things, and I think it's probably a fair assessment to say that the Biden administration is hesitant to start talking about tax increases for folks below those income levels.
Okay, and that's fulfilling campaign promises.
Correct.
So there's really no surprises, either that at the higher end taxes might go up, or at the lower end that things might stay the same.
Not as of yet. Yep.
Okay, gotcha. Let's transition. There's income taxes, estate taxes. Another big thing that our clients care about, and of course we're investment manager, are capital gains taxes. And Mary, that also affects estate planning. I think the term is the step up in cost basis. Folks may or may not be familiar with what that means. So could you maybe share exactly what the step up in cost basis is and what's currently being proposed as it relates to that provision?
Sure. Currently, if someone inherits property from someone who has died, then that person takes that property with a stepped up basis that is equal to the fair market value of that property as of the date of death of the decedent. So what that means then for that person is if they turn around and sell that piece of property, there's little to no gain. And so there's no gain liability.
Which is a huge benefit.
It's
especially if you don't know what the cost basis is.
It's a huge benefit. And you think about our clients who have real estate that's been held in the family for a very long time. There are closely held companies that have been held for a long time. So that's kind of a huge thing. What Biden has proposed on the campaign trail is that step up be eliminated, which means, and he's proposed a couple of things about that. The first is potentially that step up would just be eliminated, so that when the person then sold the property, they would have to pay gain on the difference between the sale price and the basis that it had in the hands of the decedent from whom they inherited the property. The other thing that President Biden talked about on the campaign trail was potentially having the inheritance of property be kind of an income recognition event, so that just inheriting the property meant that there might be tax due on the difference between, again, the basis that the decedent had and the fair market value, whether that property is sold or not.
Gotcha. So that's a big potential change.
That is.
Now, something that you and I talked about, and you kind of clued me in on, and I was actually a history major in college, so I love history and I love historical perspective. Can you share a little bit of the history of that provision and some of the things that you shared with me prior to this event?
Sure. I think that what's first important to note is that this has been a proposal for decades and decades. Many people have run on this platform that the step up be eliminated, potentially that there be a recognition event at death. Only one time was it successful. In 1976, as I understand it, the Congress was able to eliminate the step up in basis rule, but it was so unpopular, it kept getting postponed. And then in 1980, finally, it was decided to just do away with it and say never mind. 2010, we had the ability to choose between the estate tax or and participating in the step up in basis or not, and that was a blip in the radar having to do with some tax laws sunsetting. So that's unlikely to happen again. In my mind, the recognition event as well, without even the sale, is going to affect everybody. So even if somebody has a $500,000 estate and half of that is their mother's home that she's lived in for 45 years, that person is affected and would have to pay income tax. I just don't see on either side of the aisle that being a really popular tax law. So
Let's talk a little bit about, back up and talk about
Yeah.
the estate tax and those different limits and things along those lines. What about a little bit of a historical perspective relative to that?
To the estate tax.
Yes.
So the estate tax, those exclusion amounts that I mentioned, in 2001 were around $675,000. At one point in history, they were $60,000. So
Oh, wow.
it's important to note that those amounts have gone up just continuously, regardless of which party the president was and who controlled Congress. It just keeps going up. So I think that it would be a real change in the historical trend for it to go down. We are in a global pandemic, so I suppose who knows what could happen, but I think just historically that's the case.
Gotcha. Okay, that's helpful. I think it's good to have that perspective, because I think a lot of times we hear a proposal, a lot of us get really scared and think, how's that going to affect me and my family? But then, how the sausage is ultimately made, of what a proposal is and then what a bill ends up looking like can be very, very different. And it seems like with the COVID bill, for those that are paying attention, there's a lot of that going on right now. So it might be worth paying attention to that, because that's probably how the tax bill will end up being as well.
Yeah.
Very, very different from what you hear.
Yeah.
Tony, let's talk to you a bit about same topic, but not step up in basis.
Yep.
What are capital gains taxes under the Biden proposal potentially going to look like?
Sure. So the first thing we want to keep in mind is that folks talk about and look at capital gains income in a little different manner, because it has its own tax brackets. Right? There's a 0% rate, a 15%, and a 20% rate. If you tack on the 3.8% net investment income tax to that, which came along with the Affordable Care Act, even with that, it's more attractive tax rates on that type of income than ordinary income tax rates. So when we're looking at portfolios and working with folks on generating capital gains and losses, certainly we're targeting that lower income rate. And what the proposal of the Biden administration came out with was, in general, raising that rate that people pay on that type of income. But what's important to note is that same theme applies as it's very high income folks. In fact, it's not $400,000, it's $1 million of income where people have that threshold where they start to get taxed at a higher rate. In the proposal's case, they're looking at ordinary income tax rates, so not these attractive low brackets, but now ordinary income tax, so in theory 39.6% under the Biden administration. If someone has income over $1 million, this type of income would get taxed at that rate. Certainly a big increase from the rates that we're looking at now. What's important to also remember is these are long-term capital gains rates. So these are for assets that have to be held for 1 year before you sell them. No change to short-term capital gains rates, which if you hold an asset less than a year and you sell and generate a gain, that's taxed at ordinary income tax rates. No change there as well.
Okay. So what I'm hearing is both on the individual income tax bracket side, higher wage earners. Below that, things largely stay the same. Same thing on the capital gains side, higher levels, higher capital gains rates. But below that, do the schedules stay pretty much exactly the same there as well?
No proposed changes below that. Yep.
Okay, interesting. Let's talk about another part of the tax code that certainly affects our clients, and that would be investment income. So thinking of qualified dividends, interest, things along those lines. Any changes that you're seeing there?
No changes, but what's important to note is the main components of investment income are typically interest and dividends.
Right.
So you said qualified dividends, and qualified means typically U.S. corporations pay dividends at an attractive rate. That attractive rate is those same capital gains tax rates. So if you own a bunch of shares in U.S. companies that are paying dividends and they're qualified, they would be at that lower rate, which is an advantage to the tax return. If the Biden proposal does kick in at that $1 million of income, those qualified dividends over $1 million would be taxed at those ordinary income tax rates. So it would raise taxes on those types of incomes for folks at that threshold. From an interest income perspective, no change there, still ordinary income. And then I haven't seen anything about the change to the tax advantages of municipal bond income as well.
Okay.
No change.
Gotcha. And that's helpful. I think that covers estate taxes, individual income taxes, capital gains. dividends and interest. That's pretty much what our clients are looking at with their tax returns. Let's talk a little bit in transition to planning strategies. Very briefly, kind of high level, are there any themes that change because of this proposal, or are they very similar themes to what we do all the time? Okay. Mary, I'll start with you.
Sure. I think that I hinted at this earlier. I think that with the estate tax exclusion amount and a little bit of a tenuous situation, I think that if people are going to use it sooner rather than later. Someone's personal attorney is going to be the right person to decide whether that's appropriate or not. But as I've said so many times before to clients, I don't like the tax tail to wag the dog.
Right.
Taxes are really important, and your attorney and your planners at Johnson are going to have taxes in mind, but I think what the most important thing to think about with planning is what sort of legacy do you want to leave for your family? And it's not just about how much money do you want to leave for your family, it's about how do you want to leave it to them? What is best for them? So I think that I don't change a whole lot of my message. What are the concerns for your family? What are your concerns about your grandchildren? What charitable organizations do you want to benefit? It's still the same conversation. Taxes are in the back of our mind to make sure we do that the most tax efficient way. Yeah. But I think that I just encourage people to continue to think about whether their estate plan is up to date in terms not so much of taxes, though that's important, right, but in terms of their family.
Gotcha. Tony, what about from the individual side?
Yeah, I think the main theme that we're working with clients on over a multi-decade planning window is we think tax rates are probably biased higher.
And we've been saying that for a long time.
Over the long term, yes, we have. But now we're looking at a $3.3 trillion budget deficit last year, probably another $3+ trillion this year. I think that it's, and you heard Brandon alluding to how we're going to pay for all this. So I think over time, regardless of what happens in the next year or so, over time we think it's a good idea to start planning on diversifying your investments with respect to not only asset allocation, but with tax diversification. So planning strategies would include, if you're still working, maybe diversifying into contributing into Roths and tax deductible, so you have that mix going forward. If someone's already retired and we're in that tax window where required minimum distributions haven't started, maybe Social Security hasn't started, it's a great planning tax window where we can really manage the brackets and add income through Roth conversions, paying a lower rate today at the behest of not paying higher rates down the road. So thematically, that's what we're looking at with clients. Of course, if you do have $1 million of income, it's maybe a good idea to look at the portfolio and cash in on some of those gains at today's attractive rates. And of course, April 15th is right around the corner, so contributing those amounts to your traditional IRAs to the limits is still available until then, as is health savings accounts and other attractive retirement strategies.
Gotcha, that's helpful. So let's close with a very important question. And let's envision a day where we're not even thinking about taxes. It's Super Bowl Sunday, right? So no one's thinking about taxes. We're thinking about what's going to happen with the big game. And we've got Tom Brady, possibly the greatest of all time, the GOAT, as they call him. And Mary, you clued me in on something that Patrick Mahomes is being called the kid, which is a baby goat.
Was that me? Huh.
It actually was you, which I think is pretty cool. So any predictions? Is it a handoff to the kid, or does the GOAT get another one?
Do you have a prediction, Mary? You want me to go?
Oh, I'm just rooting for the Kansas City Chiefs.
Got it.
If my daughter gets a homework pass if the Kansas City Chiefs win, so that's a win for everybody.
Gotcha.
In our house.
All right.
I too am rooting for the Kansas City Chiefs with a bit of a bias. I am a longtime Cleveland Browns fan. And
because that's your hometown.
Because
right?
That's my hometown,
yeah.
Yes. Long-suffering Cleveland Browns fan. And we only lost to the Chiefs by 5 in the playoffs this year. So my theory is if the Chiefs go on and win, and if they win by more than 5, that makes the Browns the second best team in the NFL.
I don't know about that. I'm going to stay out of it. I'm a diehard Bengals fan. I'm waiting for them to go, and sometime be able to root them to a Super Bowl victory. Well, thank you to the two of you for lending us your expertise. Of course, we're going to learn a whole lot more as time goes on, right? Tony, maybe you can just explain really quickly how we'll let people know what we learn as details emerge?
Sure, our website is the central point focal point for that. There's all kinds of blogs that we're always keeping up, and you can see you don't have to sign up or anything. You can go there and view all the blogs that have been written for the past several years. You'll see articles
Many of which you authored?
Yes, yep. You'll see podcasts, Research Edge videos are also on there. So just a large treasure trove of information for folks. They're not too long. So it's a good educational and really get an idea how we think about these topics. I think is helpful for folks as well.
Well, thanks again. And to all of you out there, thank you so much for lending us your time, taking time out of your day to spend with us. On behalf of all of the employees of Johnson Investment Counsel, we want to thank you for inviting us into your lives, for allowing us the privilege to be of service. Frankly, without all of you, we wouldn't be here enjoying the things that we enjoy in our careers. So thank you very much for that. And if you have any friends, family members, or colleagues who might be facing a big financial decision, we would be happy to help. Our doors are always open. We want to extend that mission of financial peace of mind to as many people as we can. This whole event has been videoed. You will receive a copy of that you can then forward on to whomever you might want to send that to. Also, I did want to mention that there's a gentleman we wanted to thank by the name of David Wecker and his company Brandflick. He produced the video you saw earlier. We have one more that we want to share that goes over our regional offices and gives a little bit more detail into the culture of Johnson Investment Counsel. So once again, thank you, have a great evening, and God bless.
The friendly confines of Cincinnati, Johnson is very well known, so we took the intentional step to go outside of Cincinnati and step into some other markets. And that was really born out of the fact that we wanted to be able to serve more people. And we saw an opportunity where we were very different.
When I started with the firm decades ago, we had just one office on the west side of Cincinnati. We now have 2 locations in Cincinnati, one in Kenwood and one on West Fork Road. We have a Dayton location, a Columbus location, a Cleveland location, and now Southern Michigan.
We're not growing just for growth's sake. We are growing because we want to help more people, but we want to do it the right way. We feel people deserve that.
We're more in the middle of having the depth, the intimacy of relationship of a smaller firm, but yet we have the size, the scale, the services, and the structure of a larger firm.
We've connected with partners and with individuals that share our service model, share our culture, share our values, and that has led us naturally to grow in additional locations throughout the Midwest.
Johnson is a good company, and I knew it had a great reputation. It could fulfill all the services I needed for clients, and I felt good about that.
Our culture around taking care of clients is second to none.
There was a cultural alignment, and there was also a business model alignment where they served folks without conflicts of interest and giving objective advice.
It's really about the client and how can we add value to their situation. That was evident from the beginning when I met Johnson. We were here to serve one another, we were here to serve our clients, and it was a great opportunity.
We're truly independent. We don't have any commissions that we're paid. We're not selling commission-based products. To be able to give that genuine advice that you'd give to your friend or your sibling or your parents. And many of our relationships with our clients turn into that, really close friendships, almost family-like relationships.
When we looked at clients that were coming in and needed trust services, we developed the trust company. When the service model changed with some clients and they needed, the white glove service, we created Johnson Family Office. When there was more to be done on the charitable giving side, we created Johnson Charitable Fund. All the growth has been looking forward, helping clients solve their problems.
It's our service model that people feel a tangible difference when they experience our people.
Their focus on the long-term success of clients and client relationships, and it's not just about hitting annual goals. It's just part of the DNA we have that makes the company so great.
To me, the more clients we can attract, that means we're helping more people. That's something Tim Johnson wanted to do back in 1965. That is in our mission statement today. We want to help more people. And growth comes when you do that.